It. So for today's class, we're supposed to finish the 4 chapters. Okay, so chapter 9, chapter 11, and also I wanted to go through the final exam with all of you. Because the final exam, you are supposed to finish everything by this Sunday. Sorry, not next, but this. So this Sunday. But you do have 2 opportunities to do your final exam. But between those 2 attempts, you need to wait for 48 hours. So assuming that you do your first attempt on Friday, and then you feel like you want to do the second try because you didn't do very good work, then you have to wait for 48 hours, which means you have to do it on Sunday. Okay. So by any chance you cannot do your final exam on Friday, and then your first attempt on Saturday, then you have to ask for extension from the APA online for the second attempts, because you need extension for the second attempt for your final exam. But if you feel like you're more comfortable, like you're not need probably the second attempt, then that's okay. Don't worry about that. So just want to let you know that if you take the first time, then you have to wait for 48 hours for the second try. Okay. Now back to the questions you have. So that is for chapter 8. I know that questions. I have a lot of students. Every time I teach this course, student has a problem with that question. So take a look at this on the right side. Okay. Go click at the very beginning of this video recording. I went through the question of that chapter 8 homework. Okay, so the full bank reconciliation, we started from the examples from our textbook, so which is a very easy one. And then I move on to the homework you have, which is the one that didn't give you the starting balance of the book site. So I told you how are you going to do it. I showed step by step. So I'm not going to go through right now because it's going to take like 20-30 minutes to finish everything. But I want you to please watch the video. They're going to show you everything. I even have a Excel open, so you can see exactly what I went from the first step till the very last. And so the 2 numbers will meet with each other. Okay, so any problem on that?
No, I'll watch that.
Okay, perfect. So this is chapter 8 homework because it's very important. I have a lot of students has a problem with that, but just be careful that you're not going to see those kind of questions in your final exam, because the final exams only have 3 hours. You have to complete around 50 questions. Of course, there are multiple choices and true and false, and the 5 or 6 small answers, like short answer questions. So you're not going to see that complicated one in your final exam. The questions you may see is more likely as the examples give to you from the textbook. Okay. So for today, I'm going to quickly, because we didn't have our lectures for chapter 9. Have you ever get a chance to read chapter 9 then?
No, that's where I'm coming into issues is all the reading, doing all the exercises plus the stuff on the side. And when you're doing the questions and stuff like that, they're not just one question. There's like 20 things to do in there. So this really adds up to your time. Like I'm going like 7, 8, 9 hours as assignment just about sometimes.
I know. No, I totally understand. Yeah, unfortunately, this course is kind of, they need a more exercises, practices. There are a whole bunch of questions going on in there. But unfortunately, I cannot do to help you to complete all of the assignments. But let's just make it straightforward or simply. For chapter 9, you may have no time to read everything in your textbook. So the most important parts for chapter 9, it just talk about receivables, right? So there's account receivables are those basic definitions you have already learned from your level 1 course. So the business grows, their revenues, receivables grows as well. This whole chapter is talking about how are you going to managing your receivables. Okay, because sometimes you may see the situation that the customers cannot pay on time or they cannot pay at all. Right, so in case the customer probably go bankruptcy or there's some issues going on with the business, so they cannot pay on time, then it goes to the bad debts. And how are you going to deal with those bad debts is one of the major points we're going to learn from this chapter, chapter 9. So I'm going to quickly go through the 3 methodologies, because you will see the questions in your final exam. I want you to get clear on what are you going to calculate it actually, because a lot of students get confused about that. So this is the one for accounts for unconnectable accounts. So we call it bad debts. Chapter 9, 8. So we call it bad debt expenses. There are many indicators, such as a overdue receivables that the customer is like not going to pay. So the older the receivable, the less valuable it is because of the decreasing likelihood of a collection. Okay, so the longer of the timing and the more possibilities the customer won't pay you. So that is when we have the bad debts. This is some clues going on there. Then the method. Okay, so most of companies nowadays, they use the allowance method to account for uncollectible receivables. So the key concept is to record a bad debt expenses in the same period as the sales revenue, which is an application of the matching objective. So the bad debt expenses recorded on the basis of estimated. So it's not really happened, but it's estimated amount. Okay, so based on past experiences or professional judgment. Now, question here, allowance method. What is the allowance method? Now, there are 3 ways to do the allowance method. The 3 ways including percent of sales, the aging of account receivable, and the percent of account receivable method. So those are 3 different methods. So this is the one, and one of the major, I think is the major things you need to focus on is for chapter 9. Now I'm going to quickly talk about each of those methods. The first one is the percentage of sales method. When you see this, nowadays, most of the company are not using percent of the sales method, but we're talking about it. So you know that the differences between those 3. Now, the percent of sales method, sometimes we call it income statement approach. Okay, so the percentage used is a historical percentage based on the prior uncollectible accounts and past collection experiences. So those are based on the experiences. Now, to calculate the bad debt expense, the percentage is multiplied by the net credit sales. Let's see examples together. So based on the prior experiences, the bad expenses is 2% of net credit sales. The credit sales were $500,000. Now, the adjusting entry to record this bad debt expenses is we debit a bad debt expenses, credit allowance for doubtful account. So allowance methodology is we always set up the allowance account. That is a contra asset account. We have know that contra assets account from our level 1 learning, right? We have accumulated depreciation accounts. So there are 2 contra assets account has been used a lot. The first one is account accumulated depreciation account, and second one is this one, allowance for doubtful account. Now, so remember that the journal entry always looks like this. We debit bad debt expenses, credit allowance for doubtful account. But pay attention to the percent of the sales method. We use that credit sale $500,000 times the 2%, which is $10,000. What is that $10,000? We go to T account and you take a look at it here. So this is the T account. We have our account receivable for the company is $100,000. So this is the total account receivable we will receive from our customer. But because we know that we have 4% of the net credit sales, so that is $10,000. This number we calculated is the adjusted entry for allowance for doubtful account. It's not the target balance, it's the adjusted balance. Okay, so we have, for example, presuming that we have $1,000 at the beginning balance for allowance for doubtful account. Then we use 4% times that $500,000, which is $10,000 is our adjusted entry. Now we add those 2 up. This $11,000 is our target. Okay, so this target is the total allowance for the whole year under the account receivable. So this is our assuming allowances. right? Then our net account receivable, we use the total account receivable amount, deduct the $11,000 allowance. So our net account receivable will be $89,000. So the method, I'm gonna say the major problem here is the percent of sales method, we calculate the adjusted entry. Now we move on to the aging of account receivable. This is one of the methods that being used a lot. Most of the company will use the aging of account receivable method because it's more based on experiences, but it's more accurate because they calculate the total amount for all of those subsidiary ledgers account. So what is the aging of account receivable method? Sometimes we call it a balance sheet approach. Remember that percent of the credit sales method is the income statement approach, right? So this aging of account receivable method, we call it a balance sheet approach. We consider the age and the total amount of account receivable at the end of the period. So when you see these examples, it's actually from our textbook. So we have all those customers' name. It's like a subsidiary ledger for each of the customer. So we have their total account receivable, okay? But we can see that, for example, Calgary Drills Limited is $10,000, and the age of account receivable is 1 to 30 days. So they're 1% of this total amount that the Calgary Drills company won't pay us. Okay, so it's like 1%. So it's $100 from this total amount. Then we add all those up, all those bearing tools, Calgary Drills, Red Deer. So all those come out as a general ledger total account is $60,000 under 1 to 30 days. So we have 1% of the $60,000 is $600 probably won't pay us. So based on the percentage goes up, we have our total allowance for doubtful accounts, we calculate as $10,100. The total amount you calculated based on the aging of account receivable method is the target balance. So what does that target balance mean? When we move on to the T accounts we just showed, right? So we have our beginning balance of $1,000. Okay? We do not know the adjusted amount, but we do know the balance, which is our target total balance amount we just calculated based on the aging of account receivable. So that is $10,100. Now what you need to do, basically when you finish those calculations, they will ask you to do a journal entry. Okay, the journal entry I already showed you that it's always the same as debit, bad debt expenses, credit, allowance for doubtful account. So based on this aging of accounts receivable method, we calculate our target, $10,100. We know that our beginning balance is $1,000. Then we need to do one more calculation. We use the total target, deduct the beginning balance. So it's come out with the adjusting entry for allowance for doubtful account, which is $9,100. Then this is the number goes to your journal entry. So you see the difference, right? So for the first methodology, we calculate it directly to the adjusting entries. The second methodology, we calculated the target balance total amount. So we need two calculations to get this adjusting entries under allowance for doubtful account. So that is the aging of account receivable method. Now the next one is the percent of account receivable method. This is exactly the balance sheet based method. So the numbers you calculated is exactly as the number you calculated under aging of accounts receivable. Now, so assuming that outstanding account receivable is $100,000, 5% is estimated to be uncollectible. So we use $100,000 times 5%. We calculate it as the target amount, which is $5,000. Okay, so the $5,000 we will calculate it, we have to do a second calculations. We use 5,000 deduct $1,000. So this is 4,000 is the adjusted entry for allowance for doubtful account, which is the $4,000 going to go to the journal entries. Right, with debit, bad debt expenses, credit, allowance for doubtful account. So we use $4,000 instead of $5,000. So that make it easier to remember. Percentage for credit sales method. the number you calculated goes to the journal entry directly. So that's just the number you calculated. But the rest of the aging of accounts receivable method and the percent of accounts receivable method, the number you calculated is your total target number. When you need to put into the journal entry, you need to do the calculation, deduct the beginning balance of the allowance for doubtful account. So that is the 3 method or the 3 ways under allowance method. Any questions on that?
Just totally confused. Yeah.
No?
Not even there yet, so.
Yeah. Well, yeah. I know it's so confused because a lot of students has a problem with the journal entries to making for the bad debt expenses. Now, whenever you see the question, they ask you to do a journal entry for bad debt. This is the journal entry you do remember, right? So we start with debit, bad debt expenses, credit, allowance for doubtful accounts. Okay. The only difference is the number you calculated. Mostly, they will want you to do an aging of account receivable method. So make sure that you know this method. Okay. So what is the aging of account receivable method? Is they give you different customers situation, and they give you those numbers. It's saying that borrowing tools, account receivable, they owed you $20,000. But they're supposed to pay you in 1 to 30 days. So it's not that old enough. See, sales quoting in company. This company owes you $9,000 and they didn't pay you in 90 days already. Okay, and out of that, except that's $9,000, there's still $900. It's over 90,000 days they didn't pay you. So they still owe you. They're supposed to pay you back probably in 30 days, but they didn't. So it's over 90 days already. Then when the days goes long, the higher possibilities that the company won't pay you back. So you see that there are 90% of this total amount, this company won't pay you. So what you're gonna do is you have to calculate that total of money and then put into allowance for doubtful account. To give as accountant, you have to put into the book to show the company that we have this total amount numbers that we probably won't receive, because account receivable is assets, right? The account receivable gets higher, which means your financial situation of the company is better. But if there are 90% of those total account receivable numbers cannot receive it, those numbers are not going to be counted under your assets, right? Those are bad debt. You're never going to receive it from the company, from the customers. So that is the 3 ways. That's why we learned those methodologies to calculate those bad debts. But pay attention to this methodology, the aging of accounts receivable. So whenever you calculate the number, you just simply add it up with all the accounts receivable from the different customers, and then times the percentage of estimated unconnectable percentage. So you do the calculation and you add them up. This is the total numbers. It's your targets, total targets. You need to understand.
I see
And
it
we,
now,
yeah, so this is like, right, you add all those up. So under 1 to 30 days, we have $60,000. We have 1% estimated percentage on connectable. So we times 60,000 times 1%. Allowance for doubtful account is 600, 100, 13, and 8,100. So the total is $10,100. So this is a target. And then when we goes to our journal entry, we have to use the target, deduct our beginning balance, then put this adjusting entries into your journal entry. So it's kind of confusing, but when you really take a look at this question, you should be fine. We're gonna go through one of the final exam questions later, okay? But for now, for this chapter 9, this is one of the most important parts. You have to make sure that you understand the 3 methodologies, especially this aging of accounts receivable method, okay? Except that there are 2, I think it's a write-off. So the direct write-off method is, you know exactly. So $900, a company owes you, you know for sure that the company won't gonna pay you back. So you have to write it off. This is the way that how you're gonna write it off. Direct write-off method is you just simply take it out from your account receivable. There's no allowance. Accounts has been set. Okay, you simply debit bad debt expenses, credit your account receivable. Okay, so this is the direct write-off method. No, that's okay. One more thing for chapter 9 is the for notes receivable. Just be careful about notes receivable. Whenever you see a notes receivable situation, you will see that there's a percentage of interest you need to pay, right? The interest rate is always for a whole year. So when you do the calculation for interest payable or interest expenses, interest payable, you have to make sure that you know exactly the month. So see for this question, 12 month, 9%. So this is the annual rate, 9%. $6,000 is the principal amount. When you do the calculation, this is issued on October the 1st. So till December 31st, you have October, November, December, 3 months. Okay. So you use your principal 6,000 times 9% of the year annual rate times the 3 months out of 12 months. So this is how you're going to calculate the interest rate. That's the only one thing you need to be careful when you do the notes receivable questions. The other two that you need to remember, one is the quick ratio. Okay, so memorize this. The asset task ratio is the quick ratio. You always need a cash plus the short-term investment plus the net current receivable divided by the total current liabilities, so that you can calculate the quick ratios. And then the other ratios is days sales ratio. You have to calculate 1 day sales, use net sales divided by 365 days. And then average net account receivable. I got a lot of students do the calculation. They simply pick the current year's account receivable. It's not right. You always have to use the beginning balance plus the ending balance divided by 2. So that is your average net account receivable. And then deduct by 1 day sales. Those numbers, if you see those questions, the numbers are given to you. If they want you to calculate 2022's day sales in average account receivable number, they will give you 2022, 2021, 2020. So they give you 3 years numbers. Make sure that you do the average net account receivable number. A lot of students just simply pick 2022. That's not right. Okay, so you have to use 2022 plus 2021 divided by 2. Okay. And the next one, similar, account receivable turnover. So this ratios is the same. You have to use average net account receivable numbers. So use the beginning balance plus the ending balance divided by 2. Okay. I think that's it. So the 3 methodology focus on the aging accounts method for bad debt. And then the second one is the ratio calculations, very important for chapter 9. And then number 3 is pay attention on the notes receivable. Focus on the annual rate. It's not for, so you always need to divide by 12. Okay. So that's for chapter 9. I know that we didn't went through each slides in detail, but if you want to, see you have time. I know that you do not have a lot of time. We have detail went through chapter 9 from slide 1 to the last slide. Then hopefully you will have a better understanding. But based on the main point we just went through, focus on those 3 major points. They should be fine for chapter 9. Because the assignments you need to do or class exercises you need to do for chapter 9 is the 3-way method for allowance for that bad debt. I think you probably gonna have one question for the ratio calculations, but it's very straightforward. The numbers they just simply give to you. Now, the next one we want to quickly go through is chapter 11. So it's current liabilities and payroll. Liabilities is also the same topics we have went through from our level 1 course. So we just quickly go through that. The topics or the problems you need to focus on for chapter 11. Again, if you want to go the very detail for each each size, you just simply refers to the recordings. I send it out. Now, account receivable, current liability. What are current liabilities? How do we account for them? We have learned that, right? A current liability is a liability due within the longer of 1 year or the operating cycle. So basically, is lower than 1 year. For example, we assume November 22, Break Brewing Corporation Limited purchased inventory on credit $600. So this is purchase on credit. So we have our inventory increase. So we debit our inventory, credit, accounts payable, right? Because we owe, this is a liability, so we owe that. So we have to pay back the $600. Now, the entry recorded the payment on December the 5th, which means on December 5th, we paid it out. So we just simply decrease our account payable, which our liability decreased. So we debit our account receivable, credit, cash. Okay. So that is how the account payable shows. The notes payable, similar to the notes receivable, its only differences is one is the liability, one is the assets. But for the liabilities, it's the same there. Always focus on the rate, because you can see that this question, assuming October 31st, 2019, Safari Condo purchased inventory costing $16,000, issuing a short-term 10% note payable. So the 10% is the annual rate. Now we just simply debit our inventory, credit, notes payable. Now after 2 months, we have to record it, which is the year end, December 31st, as accounting ending period. So we need to record that interest expenses and interest payable. We use $16,000, which is principal, times 10% annual rate, which is being 2 months. So 2 out of 12. So we calculate our interest expenses and credit interest payable. Then on October 31st, notes is mature. It's already 1 year, right? So we simply record it. This is exactly the same as account receivable. It's just debit. Debit is our liability, his credit is cash. Account receivable is debit the cash, credit the account receivable, right? Now, so we debit our notes receivable, which is principal $16,000. And then the interest payable we recalculate for 2 months for last year. The rest of the 10 month we start calculated. Okay, use 10% times the 10 month out of 12. And the total cash you need to pay out is $17,600. So this is the journal entry you need to do for short-term notes payable. Bank loans and operating line of credit. Yeah, you just know it, then that's fine. So bank loans, similar short-term loans, similar to the short-term notes payable. It's just agreed with a bank or some other financial institution. And line of credit. Line of credit is the only difference is if you have personal line of credit is similar to the same thing. If you're not using the line of credit, you do not need to pay the interest rate. So the interest start calculated when you start taking money from your line of credit account. So if you didn't take any money from a line of credit, then you do not need to pay any interest on that. Now GST, PST, and HST. GST, very simple and easy, straightforward numbers, 5%. It's always the same thing. So we actually put all together as a sales tax payable. That sales taxes are connected by business, but it must be periodically remitted to the appropriate taxing authority, which is general, right? Service general. So as a business, you start collecting the GST from the customer. And in the same time, when you purchase the inventory from your supplier, you pay GST. So you need to calculate the balance between the number you collected and the number you paid out. The differences is the one that you need to submit it to the government. Normally it's quarterly. The Service General, they require business to submit their GST payment like quarterly, every 4 months. Now, I think there is examples. Here it is. So this is example, assuming a business that operates in the province without PST. So that's Alberta. Purchase equipment for $2,400 and plus 120 GST. A further $100 plus $5 GST was paid for advertising. Okay, so this is the total GST you paid out, $125. Now, the service revenue earned by the business was $4,000. So the GST connected is $200. So we can see the difference, right? So there's 125 GST paid out, $200 has been received. The difference is $75, which is the total money you need to pay to Service General or Service Canada. So the journal entry shows you for each of those business transactions. The first, when you purchase equipment, GST recoverable. So we paid cash, total amount is $2,520, and the advertising expenses is $5 of the GST, and then the $4,200 is the revenue we made. So we has connected the $200 GST. That is under debit, credit, because it's the payable. Now, when you do the calculation, the differences, we have payable $200 over the GST recoverable 125. We have 75. We need to pay cash to the Service General. Okay, so it kind of makes sense for the GST. And HST is very similar. HST is kind of combined GST and provincial taxes. So for example, Ontario, we have 13% HST. So it's not in a separated, but similar, they have the HST payable and the HST recoverable accounts. It's exactly the same as GST payable and GST recoverable account. So I'm not going to go through that. PST is we sometimes call the end user tax, because PST, sales tax payable, is only applied for connecting taxes on behalf of the government. Is not like that. So PST is always for applied to the final customer, not for the retail sales. Like if there is a retail store, if they need to purchase some inventory from the supplier, from like wholesaler, the retail store does not need to pay PST to the wholesaler. But if the retail starts selling the products to the final customer, then the customer needs to pay PST. So that is why we call it as an end user tax, because it's kind of different between the GST and the PST. But the journal entries is exactly the same as the as the GST. So we debit our account receipt. We debit cash, credit, sales revenue, and tax payable. And then when the sales tax is a purchase of supplies or inventory or equipment, we debit our sales tax recoverable and credit cash. So exactly as the GST journal entries. Now, the current portion of long-term debts is based on the meanings. So it's the current portion of the long-term debts. So for example, if the long-term debts is for 3 years, but there 10% of that long-term debt is for current portion. When you go to your balance, when you make a balance statement, then you need to take that current portion under the current liabilities. Okay, so it's kind of a separate. I think there is examples at the very bottom we're going to show. If there is a balance sheet from one of the company, they separate the long-term debts and the current portion of long-term debts. So when the investors, when the balance sheet is submitted to the general public, the investors can see exactly how much, what is the portion of the current debts, what is the portion of the long-term debts. That's for better understanding. Now, the next one, we're going to go the accrued expenses. accrued expenses has been talked about it from chapter 5, chapter 5, chapter 6 is examples like interest payable, property tax payable, salary payable. We've been using salary payable a lot under the accrued expenses or payroll liability payable. We're going to go through this two portions soon. This is one of the major topics we're going to talk about today. Now, unearned revenue. Unearned revenue is, I always give my students the examples about unearned revenue. It's, for example, if you are doing a catering business, right? So there's one company contacting you and saying that we need you to provide a catering services next month. They pay you the full amount before you even provide the catering services. That is unearned revenue. It's easy understanding. There are also some other examples like gift cards, airline tickets. It means that the money has been prepaid, but the company hasn't provided services yet. Now, the journal entry to record unearned revenue, simply debit cash, credit unearned revenue. Easy. Now, when the revenues services happened, then we just simply do the calculation. For this one, it's $20 for 16-month subscription for the magazines, right? So we simply debit our unearned revenue and credit the subscription revenue. Now the calculation is 20 times the 4 month out of 16 is actually the 4, not 4 month, but 4 issued out of the 16 issues. So they're $5. So that is how when you record the unearned revenue. So this is actually been covered from our chapter A5. Now customer deposit payment. Customer deposit payment represent the amounts, total amounts received from customers as security on borrowed assets. The examples including the router. When you need to set up your internet, the router was borrowed, and then you need to put a deposit payment on that. But when you return it, the company must refund the cash to the customer. Now, account for current liabilities. Now, the current liabilities must be estimated. So it's for a, exactly, is just for a clearance for the general public or the investors. If you put all those current liabilities, it has to be recorded and estimated. So the investor know exactly what's the financial situation of the business. So that's why we need to estimate the current liabilities. Now, estimated a warranty payable. The warranty agreements are sort of guarantees that companies make concerning the defects in their products, because some warranty agreements may last several years, right? You do not know exactly amount of repairs required under the warranty. So how are we going to deal with this kind of situations? For example, if you purchase a laptop, you purchase the warranty, then you have no idea the first time when you purchased it, you have no idea that when you're going to need those to be repaired or refunded or replaced, right? So those are all the costs that has happened to the business. Now see the examples. 2019, there are 80 millions that are subject to 1-year warranty. So the company believed that 1% of the 8 million sold is appropriate estimate of the cost of warranty. So 1% of 8 millions has to be recorded as a warranty payable. So when we need to record it, we simply do debit account receivable credit sales revenue. So that is 8 million. And then we need to record the warranty expenses as well at the same time when the sales happen. So we debit the warranty expenses, credit estimate warranty payable. Okay. So that is the journal entry you need to remember. So we debit warranty expenses, 80 million times 1%, which is $800,000. Credit estimate the warranty payable, 80 million times 1%. Now, there's something happened. Now that end of the year, the cost to repair, there's something coming back, right? And seeing that, okay, so this is broken, that is broken. There are a total $700,000 has to be repaired. Now the journal entry we need to record that $700,000 is we took the money simply directly from the estimated warranty payable. Okay, when the time we set it up, the account, so the $700,000 come from that account. Now we debit estimated warranty payable, credit cash. If this product has been replaced, we simply replace the cash with the inventory, which that we didn't pay the cash, right? Which is simply took the parts from our inventory, from our storage. So the expenses on the income statement is still the $800,000, not the $700,000 actually paid. We still keep that $800,000 as into our income statements as our estimated warranty payable. But pay attention to that part. Now, one of the most important is the estimated vacation pay liabilities. Now, as employees, we are required to take our holiday off every year, okay? Because the company does not want their employees to accrue their vacation pays for many years. And how are you gonna record it? See these examples for vacation pay liabilities. General payroll $100,000, vacation pay as 4%. So we say it's $4,000 for vacation pay. So in January, company records the vacation accrue as follows. We debit vacation pay expenses, credit, estimate vacation pay liability. Now, you was probably gonna see a question in your final exam. It's saying January payroll is $100,000. 80% of the employees gonna take their holiday off in August. Okay, and the vacation pay as 4%. When you need to do the calculation for the estimated vacation pay liabilities, remember that you always use $100,000 times that 80% of employees and then times the 4%. Then you can come out with the estimated vacation pay liabilities. Okay, remember what I'm saying because you will see the questions. Now in August, an employee with a monthly salary of $2,000 takes a 2 weeks vacation. Okay, now we need to record that. We simply 2 weeks of their salaries is $1,000, and then the other $1,000 will come from the estimated vacation pay liabilities, come from the $4,000 right there. Then with credit of various withholding accounts and cash. Okay, so that is the estimated vacation pay liability examples. Income tax payable. For corporation, it's not for personal income tax payable. For corporations, we need to have a journal entry to record a 100,000 monthly income tax installment. We simply debit income tax expenses, credit cash. Okay, so this is paid monthly to the CRA as a corporation. Now, at the year end, the corporation calculated the actual tax expenses for the year to be 1.24 million. The company pays the last month installment of $100,000, which is only 1.2 million, right? So we owe the CRA $40,000. Then end of the year, December 31st, you also need to record that $40,000 you owe to the government. With debit income tax expenses, credit income tax payable. That is how. I don't know if you have the situation for the income tax installment payments as a personal income taxes. So if you owe money to the government for the current year, for the next year, the government will send you a letter. It shows you how they calculate the installment payments amount and wants you to do the installment payments in case at the very end of the year, you're not gonna have ability to pay it in full. So this is the way it works for the corporation. As a corporations, if they always make the installment payments in case at the very end of the year, you need to pay like 1.24 million at one time. So the installment payments has been set. The calculations is very different and very complicated. I don't know if you have ever chance to take the income tax courses. They will show the 3 different ways to calculate the installment payments amount. So that's for personal actually, but corporation taxes is different. So that is how the installment payments works. And also this shows you what its journal entry looks like if you go with income tax expenses and income tax payable. Contingent liabilities. This contingent liability is totally depends on the future events. Most of the cases is the lawsuit, because in the current times, you have no idea if there's a lawsuit going on, maybe next year or in a few months later. And if you're not sure if the lawsuit is gonna win or lose, so that is contingent liabilities. This is the tables you will find out from your tax book. It helps you to determine how to report a contingent. If the amount can be reasonable estimated, and if the accounts cannot be reasonable estimated. If it's kind, then you need to accrue expenses and report it as a actual liabilities. If the total amount cannot be reasonable estimated, you simply just put into a note disclosure. Okay. If the loss would be significant, simply put into a note disclosure. If the loss could not be significant, there are no disclosure you need. If you cannot determine if there's a lawsuit, it's going to be win or loss, put into your notes disclosure. So when you ever need to prepare a financial statements, a balance sheet, of course, and then you will see a lot of notes disclosure at the very bottom of the income of the balance sheet from the general public companies. That's because there are kind of situations the accountant cannot sure at that time when they make the financial statements. So that is the contingent liabilities, the three categories. Ethical issue accounting is always being emphasized by each chapter because it is, as a business, a very important disclosure all the information to the general public, especially for their investors. And or you have to decide if you want to give away too much information or not that much. Okay. Now payroll. Payroll. If you are employee, so you should be very familiar with all those numbers. You get a payroll, we define as salary, wages, commissions, piecework, bonus, benefits. Okay. Now straight time pay. So you know that you get a base rate times the hours you've been worked. Overtime pay is always time for 1.5 times the straight time rate. So we call it overtime pay. Gross pay. Gross pay is simply the total amount of salaries without deductions. Net pay is the gross pay, deduct all the deductions, right? Like EI, CPP, union dues, sometimes donations. There's a lot of services, benefits, all those kind of things has been deducted. Then that is the net pay, which is also the check you take it home. Now we talk about the payroll deduction. Required state deductions is the ones we talked about already. Employee income tax, EI, CPP, or QPP if you're in Quebec. Now option deductions, union dues, insurance premium, charitable donations, or others. I used to work as a tax preparer. There are some people when they bring their T4s at the very end of the year, when they find it out they need to pay back to the CRA. The next following year, they just go to HR as a payroll department and asking to deduct more money. So that is kind of other situations. Like people goes to their HR department and asking for deduct more income tax or fees, so that they do not want to pay back at the very end of the year. But in that specific situations, you need to have a written documents, and the written documents has to be both signed by the employees, HRs, and the managers to make sure that they have a paper report to show that the money will be deducted from their T4 slips. Okay. Now, this is the form. It shows you how the money can be deducted. So for Hannah West, the total gross pay is $1,500. This is the one paycheck. You could see that the income taxes has been $210.74. And then the provincial government is $81.87. CPP, $70.92. EI, $24.90. Then for the employer side, the employer going to pay $70.92, exactly the same amount for CPP, and then the EI is 1.4 to pay for the EI. Just be careful. you will see the questions ask you to do the calculation for the payroll. The numbers they will give you. So see the CPP rate they will give to you. So you do not need to do the calculations. You do not need to find out the percentage. They just simply use the numbers. The EI 1.4 times the employee portion is for employer portion. So be careful, you're going to use the 1.5 times the employee portion. So you have this total amount for employer portion. Okay, see, this is 2490. So we times 1.4 is the employer share of EI to government, right? What else? Record the basic payroll transactions. So the payroll systems with a this goals is payroll register, payroll checks, employee earning records, payroll registers. If you get paid from your employer, you're gonna see this, the payroll register. Payroll check is just simply give you the check and shows the net income of your earnings, and also it shows you the deductions for each category, right? CPP or EI or other Union Way, United Way charitable donations. Okay. The employment insurance, $11.45. So you should see exactly what those money goes to where. But for right now, the company basically used the EFT, which is electronic funds transfer. So you're not going to receive the check from your employer, but they deposit money directly to your account. But you still can see this payroll check or registers from your, it should be included in your payroll bi-weekly or monthly. Recording cash payment for payroll. Most employers must record at least 3 cash payment. Net pay to employee, payroll withholding to the government, payment to third parties of employee benefits. Okay. Now we're gonna see examples together. Be careful on this payroll interest examples because you're gonna see from your final exam. Okay. Now, accrual for the weekly payroll, December 31st is $13,654. Take home pay is $10,002.28. So this is net pay. This is gross pay. Now, the 3 entries are required. First, the entries, you need to record the payroll for net wage, salary, and bonus. Second one, you need to record the employer's share of EI and the CPP. Number 3, you need to record the payment of salary payable to the employees. Now, we see that for this specific examples, the total salary divided by office salary and sales salary. Okay. Not always has been divided by those 2 arrays because this person looks like is a commission based. So they have office salary and sales salary. So the total will be their gross pay. Now, based on those gross pay, they should let you know that the employee income tax payable, you do not need to do the calculation, they give it to the percentage. Then Canada pension, EI, United Way, salary payable is the net pay. Now, one of the thing for the calculation is the EI calculation, because EI, there is a maximum of there is a annual deduction. There's an annual exemption, sorry. So for EI, there is an annual exemption. For the EI calculations, that total exemption is an annual. So for example, the EI exemption is $1,200. That is annual exemptions. But when you need to do the journal entry is for one of the paychecks, probably it's monthly, they will let you know. So if it's a monthly amount, you need to use your total EI calculation, okay, deduct that exemption, the exemption divided by 12 months, okay, because you need a monthly amount. It's very similar to when you calculate the interest for notes payable or notes receivable. Okay, so you need to calculate, pay attention. The exemption is an annual exemption, it's not for monthly. We saw lots of students when they do the calculation, they're like, the EI, there's no EI left, it's a negative number. No, it's not right, okay? Because you need to divide by 12, that total exemption, total amount. And when you finish, you calculate the CPP and EI. This is how you're gonna do the employer shares. So you debit employee benefit expenses, you credit the CPP and EI portion. The portion you need to times 1.4. And then the payroll, the last one is the cash. When you made a cash payment, this is the net pay, right? So on the side of the employer, you debit a salary payroll credit cash. So the total all month journal entries for the specific examples, we need to debit an employee income tax payable, CPP payable, EI payable, and then credit cash. So this is the total money we paid out. Then for the United Way, which is the journal entries recorded to on behalf of the employer paid the third parties, right, to the United Way payable. So that is debit, United Way payable, credit, cash. So that is how you're gonna make the journal entries. Be careful and watch out. You need to prepare at least 3 journal entries to record the payroll, because you will see exactly this one in your final exam. I think that's it. So this is the one that I just talked about it when you need to report the current portion of your long-term debts. See, this is the balance sheets for the company. Under the current liabilities, there's a line saying that current portion of long-term debts, just simply put in there. But when you report it under the long-term debt, the $90,000 is the long-term debt, but you need to deduct the $10,000 because you already reported this one on the current liabilities. So this is how you show this in the balance sheets. Sometimes the company were not gonna show that many details. They simply give you an $80,000 under notes payable. But they will have a notes disclosure at the very bottom saying that their $10,000 is current portion. So that's how that works. Any questions?
So have other people taken accounts payable, like for the payroll before this? Because I've never done any of this. And this is like major
Payroll?
work.
Like payroll?
Yeah.
You never taken the payroll classes before?
No.
Okay, so that is why I was saying that you are not gonna require to calculate it. See, for payroll, CPP calculation, income tax rate calculation, you need to give the rate and do the calculation. But because this is not a major purpose in our course, so you're not gonna require to do the calculation for those numbers they will give to you. So for example, the question was saying that, give me 1 second, I'll quickly find the question. Question. Right. So, for example, the question was saying that, okay, so the A company has 5 employees. Each person earns $3,000 per month. Okay. Then the CPP amount is 4.95%. And EI insurance is 1.78%. So you just simply need to do the calculation. Okay, we just simply use see a CBP rate 4.95% would times the $3,000, and they give you the 1.78% of the EI, and then simply times the $3,000, and that's it. You do not need to do a whole complicated calculations on that, but you do need to is to remember this journal entries that you need to do. You debit the total salary expenses, right? So that is the gross salary, right? And then you need to simply do the calculation for EI. That is the number they give to you already, CPP, and the income tax. Or there is a charitable donations, you need to put in there. If there's non-charitable donations, just leave it. And then you need to put in the salary payable, which is the net pay they should give to you in your question. So that is basically the only thing you need to do. That's it. There's no count. Because if you next month, you're gonna take your payroll class. The payroll class will show you different rate for different province for all the CPP-EI income taxes. And the question will become more complicated because you need to use each rate based on the employee's province and do the whole calculations. But for our courses, you do not need to do anything. They're not going to show you which province this person coming from or what. They simply give you the rate and do the calculations. Does that make sense?
Yes.
Yeah, so that will be much easier because the seeing that, okay, so the income taxes for each person will be 15%. Then you just simply use 15% times the gross rate, the gross salary of each person, right? I said, you may want to write it down is the question will show you there are $3,500 will be the EI exemption, a CPP exemption. So there's a $3,500 as a CPP exemption, which means that you need to use that $3,500 divided by 12. So you have a monthly CPP exemption. So when you need to do the calculation of the CPP payable, you use the monthly salary, $3,000, deduct $3,500 divided by 12, which is a monthly exemption, right? And then you times the CPP rate, 4.95%. That is your CPP payable per employee. Does that make sense?
Yes, until I get there, I guess.
Okay, perfect. Yeah, so just remember there's exemption, but that exemption is for annual exemption. So whenever you do the calculations, you use that exemption divide by 12, so you have your monthly amount. Then you just use whatever they give you, the total money for monthly salary, deduct exemption times the CPP rate. That's it. That's the only one point, because if you calculate the run about the CPP payable, your net pay will be different, right? So make sure that, to make sure that your number is correct. Now I'm gonna quickly go through the question you will see from your final exam. The first question you will see from your final exam, probably or not, because the questions I'm having is for the 2 attempts. So it's more than you're expecting from your final exam. The first one is from our chapter 7, the special journals, right? We already went through sales journals, purchase journals, cash receipts journals, and cash disbursement journals, which is cash payment journals, and the general journal. So the question may ask you to record the transaction in the general journal. They do not ask you to record those specific or special journals, only the general journals. They only record the general journal. Because I have students, they record everything. They maybe give you 10 business transactions, they're probably only 2 or 3 is general journal, which is the one you need to make journals. But they make 10. It just takes you way too much time for this question. So make sure that if, do you remember what goes to general journal? If there's nothing about cash, there's nothing involved, account receivable, account payable, the rest of the parts goes to general journal, right? So yeah, so the question you will see is to make a business transaction under general journal. And that's it. Now, the other questions you may gonna see, I want you to get familiar with the purchase journal and cash payment journal. Make sure that you know what is included in the purchase journal. For example, you have the title of the purchase journal, you have the date, you have the account, you have the term, right? You have account payable credit, you have the purchase as debit. Then you need to put a number under all those specific lines. So that is for purchase journals. Cash payment journals, the same they're saying. You always start with date, right? And then your check number, because it's cash payment. You also write down the check. Or if you pay cash, then there's no check number. The payee, so the payee information. And also there's account debit. And also their cash as credit.
Excuse me, are you displaying this? Because I don't see it.
Yeah, I'm explaining it. There's no questions from my screen. So, but you do not need to, okay, what? This is sales journal. So this is the one that talk about it. Sales journal. Make sure that you understand what it looks like. So for examples, the sales journals, the form you're gonna make it, the date, the invoice number, accounts debited, and sales journal. You'll start with accounts receivable debit, credit sales revenue, and then you have another one, cost of goods sold, credit inventory. Right, so this is what the sales journal looks like. And then the one we just went through, cash receipts journal, is a kind of different, but very similar.
Are they offering the form itself? Because making the form takes a long time.
I think so. They should give you the form as a template. So you could go to the document template, download it, but make sure that you know how are you gonna enter all those numbers in. Like the date, numbers, cash, how much cash, and then the cash or the sales revenues. So make sure that you understand for those special journals, okay? Purchase journal, especially the purchase journal and the cash payment journal. Petty cash is the one we went through for chapter 8. The reimbursement, do you remember still? So you only need to do 2 journal entries. One is when you open the petty cash account. One is when you replenishment, right? When you use the money, right? So remember, make sure that you know how to make those 2 journals on the situations. Oh, I cannot open the PPT. It's so slow. Oh, here we go. Yeah, the petty cash. This is Ford. I think it's right there. So there are only 2 journals you need to make. One is the when you start the fund, your debit petty cash and credit cash. And then the second is the when you need to replenish in the petty cash. So make sure that those are all the vouchers amount. They're always going to be the cash shorts or over, right? And then the total cash you need to replenish. You need to put more in. So you need to make sure that the total balance of the cash and the cash on hand, and then you know the rest of the numbers that you put under cash. So yeah, that's a very easy, straightforward one for the petty cash. And then the accounts receivable turnover calculations is the one we just went through today from chapter 9, the ratio. Okay, so just watch out for this average net accounts receivables. Do not simply just put a number in. You have to calculate it. Use the beginning balance plus ending balance divided by 2. That is the average net account receivable amount. And then it's going to be the bank reconciliation. Okay, so read your question very carefully because probably you won't need to do the journal entry. You probably just simply do the bank reconciliation. As we said, it's not that complicated as what you did for your homework. It just please probably just 5 or 2 lines. Make sure you know. Is that 8? Yeah, it's 8. The template we have shown in our class. Okay, so this is the template. When you see the deposit in transit, it's always at the end of bank. If there's outstanding checks, always just subtract it from your bank balance. Then watch out for the bank arrows. So if your bank connections, interest revenue, or EFT receipts, always add at the end. If there's a service charge, non-sufficient balance, or EFT payments, always deducted on the book side. And then watch out for book arrows. So make sure that you memorize this template because you're going to do the question. It's not that hard. It's not like even that long, probably 2 or 3 lines for each side. So you should be fine. Yeah, so that is the bank reconciliation. The last questions you may gonna see is the Chapter 9. Aging amount, bad debt expenses. Aging amount is the one we just emphasize it. Okay, so they will give you the total money. They will see that, okay, we'll have company A. Company A is under 1 to 30 days bad debt. The balance is $20,000 and the percentage is 1%. And then company B is under 31 to 60 days with $3,000. Percentage will be 2%. So they give you all those numbers and want you to calculate allowance for that accounts. You just simply use the number times the rate, right? Times the rate, times the rate, times rate, and then add them up. The number you got is the target balance. Use the target balance, deduct the beginning balance. You will have the allowance for doubtful accounts total amount. So make sure that you understand how you do that question. Okay, so aging of accounts receivable method. Now, the last one, yeah, the last question has always been the payroll. So we went through this today. When you go chapter 11, so the 3 payrolls is always the first journal entries you need to do when you see that the first entry to record the salary expenses and employee withholdings. So this is the one. Okay, so this is the first journals you always need to do. And then when you go to the second one, the entries that represent the employer's side share. So the employer shares always go with employee benefits and then start with CPP and EI. And then the third one is the cash, to just simply record the cash payable, cash payment for the weekly payroll. And watch out for all the cash they need to pay on behalf of the employer. So that is basically your final exam. It's fully covered by each chapter. There are 4 chapters, right? So if you understand or get familiar with the questions we just went through, you should be fine. Any questions?
Off recording, I'd like to talk to you.
Oh, sure.